Okay, so in this lecture, we're going to move on from talking just about basic stocks and bonds and talk about derivative contracts. So as the name derivative suggests, a derivative is a security whose value derives from some underlying asset. So derivatives contracts can take all kinds of forms. So we have futures contracts, we have options, we have swaps, and on the more exotic side, we have things like collateralized debt obligations. But what all of these share is that there are some conditions under which an exchange takes place or some payoffs are being made. So for example, an option gives the holder the right to buy or sell the underlying security at some predetermined price. Now, when dealing with derivatives, it can get pretty difficult to wrap your head around what you're really talking about here. And, well, the nice thing is we don't really have to worry so much about what a derivative actually is. All we really care about is who's getting paid, how much they're getting paid, and when and under what conditions they're getting paid. As long as we look just at the payoffs, we have all the information that we need. So let's think about a very basic and very common form of derivative, which is the credit default swap. Now, what motivates someone to buy a credit default swap? Well, let's imagine that you have a loan. So you have a borrower and you have a lender. And under normal times, the borrower is going to be making periodic repayments to the lender, right? The lender lends the borrower some money and then gets paid back over the term of the loan. This is something that we've seen before. Now, the problem is that, of course, the borrower may default on this loan. There may be a point where the borrower is unable to repay the loan. And this is a risk that's present in any sort of loan. And so the lender might want some protection against this default risk. So what can they do? Well, what the lender can do is essentially to buy some type of insurance against this default risk. So the lender in this case is the CDS buyer, and then we have a third party that's selling the credit default swap to the lender. Now, in normal times, as long as the borrower is able to repay the loan, the lender is going to send part of that to the CDS seller as a premium. So as long as nothing happens, the seller of the credit default swap can collect a premium, and the lender is happy to pay this premium because they're getting paid back the initial loan. However, in the event of a default, what's going to happen is that because the credit default swap seller assumes the risk in the loan, they're going to make up the payments to the buyer that the original borrower was unable to make. So the lender is going to pay a premium in exchange for this insurance. In the event of a default, the CDS seller is bearing the risk, not the buyer, which is why it's called a credit default swap. The risk of the default is being swapped from the buyer to the seller. Now, how much of a premium you have to pay for this type of protection is called the CDS spread, and that's going to measure how risky the underlying loan is. If there's a high chance of default, then in order to buy this kind of protection, you're going to have to pay a much higher premium. So we're not going to come up with a in-depth pricing model for credit default swaps. We just wanted to introduce them because credit default swaps highlight a lot of the key features of derivatives markets. So we want to think about, well, what are the motivations of everybody involved? The buyer, in this case, is the lender, wants to hedge risk, right? They have made a loan that's risky and they don't want to be bearing that risk, so they want to offload that risk onto somebody else. The seller is a third party. They're not a party to the original loan. They have no position, they have no stake in the underlying, but presumably the seller is an entity that's more able to bear the risk in the underlying than the buyer is. So they're going to take on this risk, but in exchange, they're going to collect a premium. So ideally, derivatives are a way for us to be able to share risk more efficiently, right? We're pushing risk onto entities who are more willing to bear it, and we're going to pay them a fee for that. Now, there's a couple of problems with this ideal world. The first is that, okay, the buyer is pushing this default risk onto the seller. What they're saying is, okay, well, if the borrower can't pay me back, then this third party, this insurance company, is going to pay me back. Well, there's no guarantee that the insurance company can pay you back either. They are subject to the same limitations as anybody, right? They may not necessarily be able to fulfill their end of the bargain, in which case you may have to consider reinsurance, insuring against the insurance company not fulfilling their obligations. So this might require another derivative. So this adds another layer of complexity to this problem. However, probably the bigger thing we want to consider is, well, here so far we've been thinking about the buyer as being a lender, right? The buyer has a stake in the underlying asset. They're bearing this risk that they want to hedge against. However, this does not need to be the case. Right? You think about it, the swap is a separate transaction from the underlying asset, right? The loan and the swap are two separate things. There is no requirement that if you want to buy a credit default swap on this underlying asset, on this underlying loan, that you have to be a party to it, right? The CDS buyer does not need to have any stake in the underlying. And think about what they're doing in that case. If both the buyer and the seller have no stake in the underlying, that means the CDS buyer is essentially just betting that the borrower is going to default. Now, they would be doing this whether they were the original lender or not. However, if the buyer has no stake in the underlying loan, basically what they're buying is a derivative that pays well when the borrower defaults. So you can think about this as sort of a side bet. You have two entities that are not party to the underlying transaction that nevertheless have arranged some structure of payoffs depending on the outcome of what goes on in the underlying. So you can think about this kind of market for speculative side bets. And this allows a whole host of entities to kind of gamble on the outcome of various events that they had no particular stake in before. So, a couple of basic properties of derivatives. The price of a derivatives contract is going to depend on, but not be entirely determined by, the price of the underlying. And you'll see what this means a little bit later on. So, what is a derivative doing? We're turning some property of the underlying asset. Typically, we're talking about some type of risk, right? When we're talking about the credit default swap, we're talking about the default risk in a loan. And we're turning that property into an asset in its own right. So typically with most derivatives, what we're doing is we're trading some type of risk as an asset in its own right. So you can't really talk about derivatives without talking about the role that they played in the financial crisis of 2008. So let's think about how that all came to be. So when we talk about the financial crisis, that started from the subprime mortgage crisis. So what's a subprime mortgage? Well, a subprime mortgage is a mortgage that's being lent out to a borrower, typically who has pretty bad credit. So we're talking about a loan that has very high default risk. Now, typically, this would not be a very desirable asset. Right? You're talking about a loan made to a subprime borrower, somebody who has a limited ability to repay this loan. This is not something you would want to stake in normally. However, just like we've been talking about throughout this whole class, there's a trade-off between risk and return. Yes, a subprime mortgage is not a very desirable asset on its own, but if it so happens that the borrower is able to repay the loan, the interest rates are pretty high, so you can get a pretty good return on it, right? Now, if we're thinking about buying and selling subprime mortgages as these whole assets, well, this is going to be difficult to do. But one thing we can do to make them more attractive is, rather than thinking about selling these mortgages as these whole assets, what we can do is we can pool a bunch of them, and then we can sell off pieces to different investors. And so rather than owning a subprime mortgage, you're instead owning a piece of a bunch of different mortgages. And so this is what's called a mortgage-backed security, or MBS. And these became really infamous in the aftermath of the financial crisis. So what is the reason for packaging these mortgages in these mortgage-backed securities? Well, you think about an individual borrower, an individual subprime borrower, is quite likely to default. However, if I pool a bunch of these mortgages together, it's unlikely that all of these borrowers are going to default all at the same time, right? Which means that this has mitigated a lot of the risk inherent in these mortgages, and at the same time, the investors can still get a high return. So the idea behind mortgage-backed securities was the same as with a lot of different hedging strategies, right? We're pooling a bunch of these risky assets together and then selling pieces to investors. And the hope is that, well, investors can enjoy the high returns, but be sheltered from some of the risk because, well, it's unlikely that all of these borrowers are going to default at the same time. Or at least that was the idea. Now, they actually went a little bit further than this, because when we talked about, well, we pooled a bunch of mortgages and we cut it up into pieces, well, the different pieces are in fact not created equal because we have different levels or tranches. So when the money comes in, the senior tranches, the upper levels, get paid first. And if there's money left over, it goes to the next one, and the next one, and the next one. So rather than creating this homogeneous pool of mortgage-backed securities, we've actually separated it out. So the higher levels are less risky, but of course they're going to cost more, so the return will be lower. Whereas the lower tranches are going to be the riskiest ones, right? Because these are the ones that get paid last. So if borrowers start defaulting, they're going to be the first people to suffer. However, because the bottom tranches will be cheaper, they're going to promise a higher return. And beyond this, we can go even further. Well, think about what we started with. We had subprime mortgages, which were risky, undesirable assets, and we turned them into something more desirable by pooling a bunch of them together and then cutting it up into pieces. Well, if we look at the bottom tranche of this CDO, what is it? It's a risky, undesirable asset, so what can we do with it? Well, let's take a bunch of different mortgage-backed security pools and then pool those together and then cut that up. So that's called a CDO squared. And if that wasn't crazy enough for you, regardless of how much financial wizardry we want to apply to this system, well, at the very least, right? At the very least, we're not creating new risk, right? The total risk in the derivatives market is limited by how much risk there is in the mortgage market, right? So we couldn't possibly come up with a situation where there was actually more risk in the derivatives market than in the mortgage market, right? Well, not quite, once again, because the appetite for these mortgage-backed securities was so high that the mortgage market itself wasn't able to meet all of this demand. And so what people did was they used credit default swaps to create what were called synthetic CDOs. So what we talked about, when we're talking about derivatives, all we really care about are the payoffs, not necessarily what the derivatives contract actually represents. So with a synthetic CDO, we replicate the payoffs of a CDO, but there's no actual mortgages involved, which means that by using synthetic CDOs, the risk in the derivatives market actually grew to become greater than the risk in the mortgage market. So if you look at this picture just sort of illustrates the complexity in the CDO market. Now, of course, you don't have to memorize exactly what's going on here, but if you think about it, well, if you can't really make sense of a picture like this, well, what do you think all of the investors who are buying these securities were looking at? Most of the time, they didn't know what they were buying either. All they saw was that, well, these things are promising me a very high return with very little risk. So I'm not going to ask too many questions about what exactly I'm buying. I'm just going to jump in. And as in most cases, when people start doing things like that, there's going to be problems. Now, one lesson you can take away from the financial crisis is that no matter what type of financial wizardry you use, what kinds of complex hedging strategies you use, hedging doesn't really make the risk go away. It just makes it look different. So what do we mean by that? Well, think about what we said when we were constructing these collateralized debt obligations, these mortgage-backed securities. Well, the idea is that if I have one bad loan, there's a high chance of default. But if I have a bunch of bad loans and package them together, the chance that all of them default at the same time is going to be relatively low, right? Well, as it turns out, that was not the case, right? Because we're kind of erroneously treating these defaults as independent events, but that's not really how these things work, right? Because we think about the real estate market while property values rise and fall together. So a lot of these borrowers, all of these subprime borrowers, took out these mortgages that they knew they couldn't pay back because they're like, well, we're buying into a property market that's surging. And so when the property value goes up, I can just refinance later on. However, if the property market does not follow the trajectory that I anticipated and I'm not able to refinance later on, then, well, I have no way of actually paying it back because I had no way of paying it back to begin with. And so that's exactly what happened. A lot of these borrowers who took out these loans that they knew they weren't able to pay back and were counting on the housing market to keep rising, all of a sudden, once the housing bubble burst, then they all started to default at the same time. And this was something that, all of this financial engineering that we used to construct these CDOs and CDO squares and synthetic CDOs didn't really take into account. And so when all of these subprime borrowers started to default all at the same time, this entire market collapsed. So what are some lessons that we can take away from the financial crisis? Well, everything rested on this shaky foundation, right? We had these pools of subprime mortgages, and we thought that we were able to hedge away the risk because there was no way that all these borrowers could default at the same time. And once all of these borrowers started to default at the same time, then the whole house of cards started to crumble. So repackaging risk didn't make it go away. But what it did do, though, was really confuse a lot of the investors who were buying this stuff because they didn't even know what they were buying in many cases. They were just lured in by this promise of high returns with very little risk. Well, as it turns out, what they were buying was a lot more risky than they thought. And this is true for most hedging strategies because hedging strategies are never perfect. You can never make risk go away because there is underlying risk in what happens in the real economy, and there's no amount of financial engineering that can just make that go away. And what they do, though, is they blind people a little bit, right? Because these hedging portfolios that look like they've kind of taken care of every contingency, it makes you feel safe because you're getting paid better in normal times and kind of under moderate fluctuations. However, under certain unforeseen circumstances, the negative consequences can be severely magnified, right? So think about all these derivatives contracts that were written on these subprime mortgages. Yes, in normal times, as long as the housing market continued on its anticipated trajectory, everybody was doing well. But once things started to turn south, everybody suffered, and suffered a lot more than they would have if not for these types of derivatives. So when we're talking about derivatives pricing, let's start with a type of derivative that we've seen already, and that's the forward contract. So the idea behind a forward contract is that we're agreeing now to make some transaction later, and this we've seen with interest rates, right? Because we talked about spot rates versus forward rates, right? We can think about agreeing to exchange a certain bond at some specified date in the future at a specified price, which implies a forward interest rate. So, forward contract is going to lock in a price and is going to shelter both parties to this contract from whatever price movements happen between now and the delivery date. So we make the agreement today, and then at some point in the future, we arrange delivery, and then at some point past that, whatever payoffs this underlying asset promised are going to take place. So this is the structure of a forward contract. Now, forward contracts are typically traded over the counter, which creates a problem because it creates this problem of counterparty risk. With a forward contract, I'm agreeing, for example, to deliver something to you in the future. Now, if it's in my interest to do so, of course I'll do it. If it's not in my interest to do so, let's say I promise to sell you something for a low price today, but in the meantime, between today and delivery, the price of the underlying has gone up, and now it's not really in my interest to follow through on this contract anymore. And because forward contracts are traded over the counter, if I just want to renege on this contract, you don't have that much recourse, right? So forward contracts are useful, but also problematic. What we really want is some type of forward contract where we have a mechanism to hold the other party honest. And this is a futures contract. So a futures contract is a standardized forward contract that's traded on an exchange. And the key mechanism with futures contracts is that they're marked to market, which means that both parties have to maintain a margin account, and as the price of the underlying asset fluctuates, whatever capital gains and losses they accrue are going to be reflected in the margin account. So, if I promised to sell you a stock, for example, at, let's say, a price of 100, then if the stock price were to rise, the more the stock price rises, the more money will be deducted from my margin account, which means that if I want to bail on my commitment, well, I will have already taken the loss. I'm not able to bail on the commitment and save myself from suffering a loss. So the margin account basically keeps both parties honest. It forces them to remain committed to following through on this futures contract. Now, what happens if your margin account runs out? Well, if your margin account falls below a certain level, you're subjected to what's called a margin call. And if you're subjected to a margin call, that means that the money in your margin account is about to run out, and you need to put more money in, or your position will be automatically closed. So the margin account, the mark-to-market feature, keeps both parties honest. It forces the parties to follow through on their commitment, because whatever gains and losses they will have suffered from the movement in the underlying will be reflected in the margin account. So futures contracts are really popular in commodities markets because, for example, if I'm an airline, I know I need jet fuel, but I may want to time my purchase based on the market price. So with futures contracts, I can buy the fuel when the price is favorable, but arrange to have it delivered only when I need it. And this is true for many different types of commodities. So one example that I particularly like are pork belly futures. So pork belly futures are exactly what they sound like. They are futures contracts for frozen pork bellies. So these were useful, right, because they allowed meat packers to arrange delivery during the summer when the demand for bacon was higher, but they could be traded so that they could obtain the most favorable price. Now, sadly, pork belly futures are no longer being traded on the mercantile exchange because, as it turns out, there's really no need for this anymore because there's no seasonal demand for bacon. As it turns out, people these days eat bacon pretty much year-round. So I really just like this picture, because you can think about pork belly futures, bring everything back, right? Because it's very easy for us to think about what goes on in financial markets as just this abstraction, as just this sort of game that's being played between these investors and traders that exists totally separate from the real economy of goods and services. And that's not true, right? Fundamentally, everything that happens in financial markets is to some degree rooted in the actual production and consumption of things that normal people would want, like pork bellies. Let's look at an example of trading a futures contract using a margins account. So let's say we have a contract for 1,000 barrels of oil at $100 a barrel. So we have a contract to exchange 1,000 barrels in the future at a price that we set today. Now, if this price starts to move, then it's possible that one party may have an incentive to renege on the contract. So to prevent them from doing that, we use the margin account. So we're going to set an initial margin of 5,000. So the buyer needs to put 5,000 into a margin account. The seller also needs to put 5,000. So let's say the price drops from 100 to 99. Well, if it drops from 100 to 99, then that's going to be good for the seller, bad for the buyer. How good? Well, we have 1,000 barrels, right? So every dollar that the price goes up or down, we're going to adjust the margin accounts by 1,000. So here, that means that the buyer's margin account is going to go down to 4,000. The seller's margin account is going to go up to 6,000. Well, you can see that it doesn't take that much of a price drop for one of the trader's positions to get wiped out entirely. So let's say the price falls again. Let's say it falls to 98. So here, the seller would have 7,000, the buyer would have 3,000, and we're going to say that if the initial margin requirement is 5,000, we have a maintenance margin requirement of 3,000, which means that if your margin account goes below 3,000, you need to either deposit additional funds or have your position closed. So the buyer has two options here. They're going to get hit with a margin call. They can either put in $2,000 more and keep their position open, or their position will be closed for them, which means they're going to take a loss of 2,000 and they're not going to be held to following through on the actual transaction. All right, so let's think about what might happen to the margin accounts of the buyer and seller over a couple days as the price is fluctuating. Well, they're both going to start at 5,000. If the price drops to 99, the buyer is going to be at 4,000, the seller will be at 6,000. If the price drops to 97, the buyer will be all the way down to 2,000, which means that they're going to get hit with a margin call. So they're going to have to put in another 3,000 to keep their account open. The seller is fine. They're going to be at 8,000. If the price then goes from 97 to 101, the buyer will gain 4,000. So they have 5,000 at the end of day 2 because they need to bring it up to 5,000 because of the margin call. So they're going to have a total of 9,000 on day 3. whereas the seller's margin is going to be deducted by 4,000. They're going to have 4,000. If the price goes up again to 104, the buyer's margin account will go up to 12,000. The seller's will be down to 1,000. And they're going to be subjected to a margin call. If they want to keep their account open, they have to put in another 4,000. The buyer, after day 5, when the price drops to 103, will have 11,000. The seller will have 6,000. So let's think about what happens here. After 5 days, let's imagine that the futures contract expires after 5 days. The buyer put in 5,000, and then they put in another 3,000 in day 2. They took out 11,000. So what does that mean? That means they gained 3,000 as a result of this margin account, which, by the way, is exactly how much they would have gained if they had simply bought the oil on the spot market, right? Because the price went from 100 to 103. So if you had bought 1,000 barrels of oil, you would have gained, and then sold them at 103, you would have gained 3,000. The seller put in 9,000 and took out 6,000, so they lost 3,000. Once again, exactly what they would have lost if they had sold 1,000 barrels on day 0 and bought it back on day 5. Okay, so we saw that through the mark to margin, the buyer gained 3,000 and the seller lost 3,000 over the life of the futures contract. But now we have to actually think about delivering the oil. So the futures price was $100 a barrel for 1,000 barrels. But we are going to deliver not at the initial price of 1,000, but at the final price of 103. Why? Because, well, if the buyer is going to pay 103 per barrel, they're going to pay 103,000. The seller is going to gain 103,000. The total payoff is going to be minus 100,000 for the buyer and plus 100,000 for the seller, which is exactly the payoffs they would have gotten if they had traded this over the counter using a forward contract. So we use the final price to determine the cost of delivery rather than the initial price, because the capital gains and losses are exactly canceled out by what happens in the margin account, which means that the total payoffs are exactly the same as if we use the initial futures price. So essentially, as long as both the buyer and seller keep their margin accounts open and follow through at delivery, their payoffs are going to be the same as if the mark-to-market mechanism didn't exist. So the mark-to-market mechanism only exists to keep the parties honest. It does not actually change their payoffs. By using the margin account to keep the buyer and seller honest, they would get the same payoffs that they otherwise would have had. But, and this is something you may have noticed already, right? The buyer, yes, they had to put some money in the margin account, but they didn't have to put the full value of all of these contracts, right? All these contracts are worth 100,000, but the buyer only had to put 5,000 into the margin account to start with. So what does that mean? Well, the buyer had to pay 5,000 initially. They did get hit with a margin call, so they had to put in another 8,000, but for an initial investment of 8,000, they gained 3,000. Now, they might decide, well, I gained 3,000 through this mark-to-market mechanism. Forget the oil. I just want to keep this. What can they do? Well, rather than actually taking delivery of the oil, what they can do is to sell offsetting futures to exactly cancel out their position. So, and the seller presumably could do the same thing. So we can just ignore the delivery altogether and then just think about the payoffs that the buyer and seller made through the margin account. The buyer put in a total of $8,000 into the margin account and gained $3,000. That is a much better return than they would have gotten if they had just bought the oil on the spot market and held it for this period of time. The seller, conversely, suffered a much larger loss than they would have suffered had they sold the oil on the spot market. So we can think about what kind of the true purpose of the margin account is in practice in many cases, which is that traders can use the relatively low margin requirements for future. That traders can use the relatively low margin requirements for futures to greatly multiply the potential gains they can make from relatively small price movements. If you think about it, in this example, the price only went from 100 to 103. It did not change by that much. However, in percentage terms, the buyer made a very high return because they only had to deposit $5,000 in their margin account, not the full value of $100,000. Now, the flip side of this, though, is that if it's multiplying potential gains, it can also multiply potential losses. So we have been a little bit careless over the last couple slides because we've been talking about the price of oil. The price of oil went from 100 to 103, and we've been very careless in not really distinguishing between the spot price and the futures price. We talked about them as if they were basically the same thing. So what gives? Well, as we will see, there is a very strict relationship between the spot price and the futures price. The futures price cannot vary independently from the spot price. So why is that? Well, so let's define a couple things. First, let's let little t be the purchase date and big T be the delivery date. And we're going to let R be the risk-free rate. And so the spot price is going to be ST. This is how much it would cost to buy the asset on the spot market. And F, big T, little t, big T, is going to be the futures price. This is the price of the futures contract that you buy at time little t and which is delivered at time big T. And so we're going to show that the futures price must equal the spot price multiplied by e to the risk-free rate times big T minus little t. So basically, the futures price just has to equal the spot price with accumulated interest over the life of the contract. And why is that? Well, just like with all similar examples we've encountered in this class, we're going to use an arbitrage argument. So let's imagine that the futures price was higher than this. What can we do? Well, with most arbitrage portfolios, we want to sell the overvalued and buy the undervalued. So what can we do? Well, let's short the futures contract. This means that today we get nothing, and in the future we're going to receive the futures price and will be obliged to deliver the underlying. So in order to be able to do that, we have to go long on the underlying asset. So go long on the underlying stock or the commodity or whatever. That means that we have to pay the spot price today. In the future, because we're already obliged to sell it, we get no payoff from that. And to make up for this, we're going to borrow at the risk-free rate. We're going to borrow enough to buy the underlying at the current spot price, and then we have to pay that back at the risk-free rate. So if you look at this portfolio, the net payoff today is 0. The net payoff in the future is the futures price minus the spot price with this much interest accrued over the life of the futures contract. And if the futures contract is greater than this, then we get a guaranteed positive payoff in the future with no initial investment required today. So it can't be the case that the futures contract is greater than this, or else there's an opportunity to get free money. So if you've been paying attention in this class, you know what's coming next. What if the futures price were less than this? Well, now we have the same arbitrage portfolio, except we just do everything in reverse. So we're going to go long on the futures contract. We're going to short the underlying, and we're going to lend at the risk-free rate. And so here, the payoff will be positive if the futures contract is less than the spot price times e to the r big T minus little t. So once again, we have a situation where if the futures price is too low, then we have an arbitrage opportunity again. So what can we conclude? If there's no arbitrage, the futures price must equal the spot price times e to the risk-free rate multiplied by the duration of the contract. So this is the basic futures pricing formula. There are a couple of caveats that we have to think about if we're, for example, considering dividends and storage. So what do we mean by that? Well, when you buy a stock on the spot market, you own the stock, and therefore whatever dividends you're getting paid, redo. Start of slide 20. So this is the basic futures pricing formula, although we do have to make some adjustments if we're thinking about dividends or storage costs. So what do we mean by that? Well, if we buy the stock on the spot market, we actually own the stock, which means that whatever dividend payments are coming, we actually receive them. For a futures contract, if I buy a futures contract, yes, I will receive the stock in the future, but I don't yet have it, which means that I'm not actually getting any dividend payments I would have received if I had bought the stock on the spot market. So I can adjust this formula. If I think about Q as being the dividend yield, rather than having R here, I'm just going to have R minus Q times E times big T minus little t. So this just reflects the fact that if I buy the futures contract, because I don't actually own the stock yet, I'm missing out on the dividend payments. If I'm talking about a commodity, I have to think about a couple of different things as well. Because one of the reasons you would buy a futures contract in the first place is because you don't need this commodity until the future, and if you received it now, that's just going to create more of a hassle because you have to pay the cost to store it. So if S is the storage cost, then I'm actually able to save the storage cost, which means that the futures contract will actually be worth more the more storage costs I would have otherwise had to pay if I had bought the asset on the spot market instead. But the flip side of this is that, well, if there's a storage cost, there's also what's called a convenience yield. And This is similar to a dividend yield in that, okay, if I buy the oil on the futures market, yes, I don't have to pay to store it, but I don't actually have it, therefore I'm unable to use it. So this is something that I'm going to miss out on if I buy the asset on the futures market. So if I'm talking about a commodity, I have to modify the formula to account for storage cost and convenience yield. The storage cost is something that I save, but I lose out on the convenience yield. When we were talking about the properties of derivatives, I said that a derivative's price depends on the price of the underlying, but can move independently from it. Now, if you look at this equation, that's not really true. According to this formula, the spot price and the futures price kind of have to always move together. And this is because futures contracts are not true hedging instruments, right? What you're really doing when you're buying a futures contract is you're just delaying, right? When you buy the futures contract, let's say you buy oil futures at $100, you are committed to holding this position, which means that yes, if the price of oil rose, then you would benefit because you could pay $100 rather than whatever the price would be in the future. But if the price fell, you'd be stuck paying more. You wouldn't have a choice, right? So futures contracts are not really hedging instruments, right? Fundamentally, when you buy a futures contract, you're really exposed to the same risks that you would be exposed to as if you had just bought it on the spot market instead. The only thing that changes is that the timing is changed, but your exposure to risk is fundamentally the same. Which means that if I want to think about a true hedging instrument, something that will actually help me mitigate risk, I need to introduce some type of element of choice, right? What if I design a contract where in the future, rather than being obliged to follow through on this commitment, I had the option to follow through if I wanted to, but if the price turned out to be unfavorable, I had the option to decline it. So this is what we're going to talk about in the next lecture. We'll start talking about options, which are, unlike futures, are true hedging instruments.